Welcome back. It's time for another awesome panel. This panel is titled AI and Asset Management, Alt Data, Prediction, and Automation. Please join me in welcoming our panelists to the virtual stage.
Hello, everyone. Welcome to our panel. My name is Ioana Boier, and I'm the head of Quantitative Portfolio Solutions at Alphadyne Asset Management. It is my privilege to moderate today's panel as well as to participate as a panelist. And I'm delighted to be joined by Peng, Peter, and John, whom I would like to ask to introduce themselves at this point. Peng, why don't we start with you?
Hi, everyone. This is Peng Cheng from JP Morgan. I'm part of the global research at the JP Morgan Investment Bank, and my responsibility includes producing research on machine learning and alternative data, and produce these research analytics for our buy-side clients.
Peter?
My name is Peter Hafez. I'm the Chief Data Scientist at RavenPack. As part of my team, we are very much engaged in doing research on our own data, providing thought leadership into the marketplace, as well as speaking to clients about various applications of our data. RavenPack, as a company, we are a big data analytics company with expertise in natural language processing. We were founded back in 2003, so we have been part of the alternative data industry even before it was called alternative data. We have gotten to see over the years quite a lot of how the market has engaged in this space.
Indeed. And John?
Sure. My name is John Ashley. I'm the General Manager for Financial Services and Technology at NVIDIA. So we support the platforms that enable high performance AI and machine learning really across many industries, but my focus is the financial services industry. So use cases across the board from asset management to trading through to retail banking and consumer finance.
Thank you. So we are ready for our first question. So to start us off, AI and asset management, is it a perfect match or a breakup waiting to happen? These are quite extreme, two extremes, right? Either a breakup or a perfect match. What do you guys think? Anybody wants to start?
Oh, I'll start.
Go ahead.
I'll say it is going to be both, right? There are firms that are going to adopt and adapt. And for those firms, it's going to be the entryway to a faster treadmill, right? That's going to be the on-ramp to a place where competition is fierce. But if you don't get on that on-ramp, I think it's going to be a bad breakup. I think it's going to be ugly if you don't adopt. The tools to, whether you're discretionary or on the algo side, in terms of how you're managing your assets and how you're building your portfolios, quantitative or factor-based, you either need AI assistance or you need at least the most modern ML and AI algorithms you can find to give you input to your process. I'll leave that stake in the ground.
Yeah, I'd like to add to that and say,
so you're saying there's.
Yeah, I just wanted to add and say, perfect match for sure. That's a very extreme claim, but it's definitely a great match. And I think it's just important that we understand that not everything is a nail, right? AI and if we look at it also, as machine learning, has its advantages for certain types of applications. It's surely sort of already proven itself, right? Over the last, let's sort of expand it out and say 20 years. especially in areas, I would say, where it comes down to preparing data, for instance. I mean, we operate in a space of natural language processing. That is a field that is quite developed now and leans heavily on machine learning today. It's not always been the case. There are also a lot of other techniques that can be used within natural language processing. But I believe we have enough proof today to already show that machine learning and AI is useful, at least when it comes to preparing data, extracting information from textual content, from images and so on. And then of course they also have, today there's a lot of AI and machine learning being used in predictive modeling and signal generation for alpha and for risk management and so on. So, I mean, thinking about it broadly, surely there will be, it's a great match, but there are definitely also areas where there will be real challenges.
Yeah, I think if I can add to that, maybe 5 or 6 years ago, people had probably a bit of unrealistic expectations of AI and machine learning. So maybe that was kind of honeymoon period, and now we're getting to the more kind of normal days of marriage, in the sense that I guess 5 or 6 years ago, I would say when people look at AI and machine learning, very simple applications to say, okay, my Y variable are just asset returns or stock returns. And then I'll just throw as many variables I can to the right-hand side and apply a, could be a neural network model or any kind of complicated modeling, and then see what the machine spits out. And I think over the years, what we've learned is that actually this kind of approach probably doesn't really work very well, because oftentimes it doesn't matter how complicated the model you employ or how many different data sets or variables you use. A lot of times, actually, they don't beat linear models in out-of-sample modeling. So now I think the applications of AI and machine learning is much, much more focused. So as Peter said, NLP is one area where it's very, very mature. And I think everyone is looking at it, and everyone is at least aware of the use of machine learning and AI. On the other hand, in a lot of the other areas, especially when it comes to, I think, a lot of the signal generation, it's surprising how resilient linear models can be. And our experience probably, machine learning there provides incremental benefit. So maybe if I have a strategy with a Sharpe ratio of 1, and a nonlinear model may improve it to, if it can improve to 1.2, 1.3, then we'll be very, very happy. So I think that's kind of maybe the expectations that we have, having learned over the years.
I think also, I mean, it's important to think about.
My view is also that. I was just going to add that my view is also that it's really neither. It's not necessarily a perfect match, because a lot of these techniques have been perfected outside of finance, and in fact, the data that they were developed on was very, very different than financial data. So a lot of work to make them directly applicable, and then especially in the discretionary context where I work. But it's also not a imminent breakup from what I can tell. It's just more tools, and in some cases more powerful tools for us to have in the tool set, in addition to what we've been using in finance for so many years. So go ahead, Peter.
Yeah, I just wanted to add, I mean, I like to say that it's not one size fits all. It very much comes down to the problem that you're trying to solve. Of course, we deal a lot with ML and NLP, but we also use more traditional techniques like simple rules. It very much depends on what is the type of content that you are trying to attack. What is it that you're trying to extract? Certain things you can rely on. You don't have to use various deep learning techniques and so on to extract the value you need. But it's definitely useful to have a lot of tools available to you, because each one has its advantage and disadvantage, and sort of using the right tool at the right time is really where that is the important part. And I think that's something important to remember.
Yeah, definitely. And then we'll explore these ideas a little bit further. So let's get to the next question. theory and in practice, what advantages does artificial intelligence offer asset managers? And please be specific. And I guess I'll start with this one because I work for an asset management firm. So I think there are basically several advantages. From what I like to group them into the data side and the model side. So on the data side, I think there's advantages, as you guys were saying before, that you have techniques such as NLP, for example, or computer vision for dealing with non-numerical data sets. And these non-numerical data sets are valuable data to add and to enhance traditional, let's say, time series data that we've been using in finance. The other thing on the data side that I wanted to add is this notion of data augmentation, right? Like with the advent of these techniques, I feel like there's a lot more emphasis on probabilistic approaches versus a single number type of outcome. There is also more emphasis on trying to augment the data beyond, let's say, past historical realizations to either sample from particular distributions or come up with similar data sets that can be used for training the models. And then on the model side, I feel like there's advantages going beyond linear relationships, whether it's the linear regressions that were mentioned earlier, but also beyond like correlation measures like the Pearson correlation, which is very linear. And then in terms of model robustness, I feel there's also a lot of advantages related to not being tied to a single model, but rather have these ensembles of models that are giving us perhaps more intuition as to the model error and try to not overfit and not believe in a single model, right? Any other thoughts on this?
Yeah, maybe I can kind of add a little bit just on the back of what you said. I think a lot of the classical finance that's been done has assumed relatively simple mathematics, not because we're not able to, incorporate complicated mathematics, but just because it's more convenient and maybe it's just more elegant. It's a more elegant solution. But now with computationally more intensive techniques, I think we can actually do away with those assumptions that are unrealistic. Now, of course, one could say that, okay, all models are wrong, but some are more useful than others. But when you have normal distribution assumptions and you see events with a standard deviation of 10, 20 happening, 3 days in a row, I don't think anyone can any longer justify, this kind of normal distribution. So, it is happening more and more often, right? In 2018, for example, you probably remember VIX went from 17 to 37 in February, and not to mention in 2020, where we had S&P going down 5%, 7%, a few days in a row. So I think it's very, very urgent for asset managers to adopt to this new environment, and to recognize that, okay, maybe the classical models no longer suffice because now we're in a much, much more, complicated and highly volatile environment. And that's basically where AI and machine learning comes in, no longer assuming normal distribution, but let's say relatively robust distribution assumptions leads to better portfolio allocation, better, more robust strategies. So I think that's something that has really what's value added about AI, given what's happened in the last couple of years.
I think also AI has allowed us to increase efficiency in information consumption, if you may say, or really opened up for us to start to consume a lot of content that just wasn't available to us before. So the whole sort of alt data space is very heavily reliant on AI, and I think that is bringing about increased efficiencies in various processes, right? So I think that is a real advantage, that you can start automating let's call it, information extraction and decision making to a larger extent. And I also think there are other advantages with embedding AI, such as being able to potentially reduce human biases in decision making. Of course, that is to some extent, the human element is what discretionary investors take advantage of. But in some cases, there are good sort of domain expertise you want to add, but the negative biases you want to remove, and that is possible. Of course, we can then enter into the discussion of saying that there could also be data biases, but they may be, I wouldn't say easier to address, but it's definitely something that you can perhaps work your way out of, as long as you are able to identify those biases somewhat easily. So I think that's definitely an advantage, and generally I totally agree. I mean, with everything that has been said in terms of having more robust modeling, and I think also AI offers a way of sort of systematizing your knowledge base over time, and almost having an automated way of improving or increasing your knowledge base over time. And I think that's also one of the things that John alluded to early on in our conversation, that you need to get into AI and machine learning early on, because sort of the knowledge that your system gets to sort of increases exponentially. And with these sort of exponential problems, I mean, if you don't get in early, you might be left behind.
And maybe I'll just add a really brief comment, because it kind of links some of the things that have been said, but maybe hasn't been said explicitly. One of the things AI, these new ML and AI techniques let you do, because this isn't settled science, right? There's still a lot of art to this in knowing when to apply, how to take, right? But these AI techniques, these deep learning techniques, let you combine multiple data sets and context into a context in a way that is harder to do with traditional analytics. It also lets you pull potentially more information out of the same data feed, right? With finding these nonlinear patterns, finding these NLP patterns that you can now relate in these nonlinear ways to other data sets you have. So if I'm, the common sort of criticism of all data is, I can buy the same data stream you have. Now we both have the same data, no advantage for you. That may not be true. I may not have all the data you have. And if you can use these techniques to combine some of that data into context that I don't have, you now have information I don't have, even though I bought maybe one of the same feeds you did. Or you're able to do it because you've been fine tuning your language models and your sentiment models away from, the Google model, which is generic, to the model that understands the way the markets react to news. You'll know if you run both models, you'll see that delta, and you'll know when other people that aren't running and making these kind of investments are going to get a different signal than you have. And that's an information advantage that is hard to get with traditional ML.
Yeah, I totally agree on that. Just to add to a little bit, I think, let's say neural network models or whatever, machine learning models, one of the most important specifications are basically these hyperparameters, right? And a lot of times what we do is we just, do cross-validation or some out of sample testing. But I think we all know, for people who have done a lot of these analysis, we know that, like a lot of times just one little change in the hyperparameter could make a huge difference in your model, and make a huge difference in the how valuable your model is. And that's not something that you can just look it up online or ask someone else. It really comes from either robust testing or from experience. So even if you have the same data source, deploy the same model. At the end of the day, it's a lot of times these little things that differentiates the performance of models.
Yeah, and I think also there's still a high degree of domain expertise that has to go into the process itself. Also, the domain expertise on particular data, and that will not necessarily be the same that everyone has. I mean, I tend to say to our clients, right, that if you look at something like news, I jokingly call that a career data set, because you can keep going at it from many different angles. And I mean, I don't think personally that AI and machine learning are at a stage where you just, plug in, 100 different data sources, and then it comes out with all the information you need and the signals, right? So you still need to have some sort of idea of what it is that you're trying to extract, and embed your domain expertise on how to look at it, or how to clean the data, or how to do all of this sort of work. And which ones could be interesting to combine. I think you still can benefit from having an initial idea of what it is that you're trying to achieve, and how you might want to go about doing it. So I think there are so many different ways of combining things together, so many different techniques that, I mean, you won't have two firms doing the exact same thing.
Yeah, definitely. And it basically forces firms to think of their data strategy and how to organize and take advantage of data as an asset, right? So on that note, I think this is a good segue into our next question. So what challenges do asset managers face when incorporating artificial intelligence into their businesses? Anybody wants to start?
I'm happy to kick it off. I mean, I think it's very different for different organizations what their starting point was to begin with. But I think it was also mentioned earlier that if you go back a few years, we probably had unrealistic expectations. And I think that there has been a big challenge for a lot of organizations, that it's been built up too much or overhyped. And it has been difficult perhaps to deliver the value as quickly as, let's say, management would have wanted it to be delivered. So I think instead of, I mean, that has definitely challenged some organizations that have had some setbacks, and then perhaps rethought their process and having come up with a more realistic sort of roadmap for implementation. And I think also what is important to think about is that it's not just adding 5 people and having them sit there in the corner and think that they can sort of revolutionize an organization. It's a big investment. It's a big investment in technology. It's a big investment in data, potentially. It's a big investment in selling it into the rest of the organization and getting everyone on board on it. It's important also to think about short-term strategies, perhaps working closely with vendors, not thinking you can solve all of the problems by yourself. It's better to perhaps start off with something off the shelf to go in and provide some early successes, so you can also manage the political battles, and then you can always build on top of that. But I think that has been a real challenge. But also, as you said, Joanna, I think an AI strategy has to go together with a data strategy as well for it to be successful, and let's call it almost like a change management program as well. Right.
Definitely, and we talked about that, and we said a few things about methods, right? Like how some I mentioned earlier, they've been developed outside of finance, and we're trying to adapt them to the realities of the data that we do have in finance. But I think there are many additional aspects, right? Like one of them, especially coming from a discretionary setting, is trust, right? Like trust in the inner workings, especially the more complex the model gets and the more non-intuitive the result or the output. There is a necessity to understand the inner workings of how the result was opened, at least at first, right? And then once let's say the technique or the model has a proven record, then people are more willing to accept that. But this big notion of trust, which links into explainability and other transparency of these more complex models. And then there's, I feel like there's a big also discussion around security, especially in, if these models have to run in the cloud, right? And shifting data elsewhere. Well, that's a big item, at least in the early stages. It seemed like it was a non-starter. Now it's getting more and more accepted. But I was curious, John, if you have any thoughts on that, because that's perhaps NVIDIA is one of the leaders in that area.
So, and we work with customers that have adopted an on-prem strategy for their data. And I think in this case, right, AI and ML techniques are so data dependent that where the data is where the compute has to be. So we have some customers that we work with that are, this data has, we've got proprietary bits in there and they're not going off, outside our firewall. We work with other customers who, most of this is market data, most of it's news feeds and all data that we bought. The data isn't what's sensitive, it's our algorithms and what we do with it that's sensitive. So yeah, we're going to put it all in the cloud and we're going to enjoy that flexibility and pay the premium for the flexibility. And then there's customers in the middle. I think one of the things that you do find with, as you would begin to adopt ML and AI, you start, hey, the quickest way to do it maybe is to start in the cloud if your data's there. You have to start where your data is, but if your data is already there, it's quick, it's easy, I can spin it up. The economics sometimes shift, right? When that team of 1 becomes a team of 5, becomes a team of 10, becomes 6 teams of 5 on different desks, and they're all pulling data and they're all, Peng talked about hyperparameter tuning, right? The more complex these models get, the more you want explainability in the models, the more runs you do, the more training you do, the more models you try. That can become very expensive in the cloud, right? When you're paying for your compute by the hour. And so we see people sometimes, having this strategy where they start in the cloud, they go to hybrid, and then they move to hybrid, right? Buy the base, rent the peak. But thinking about how that's going to work with your IT and your infrastructure, as well as your data science and your trading and potentially your customers, complicated stuff.
Thank you. Any other thoughts?
Yeah, I think
Well,
maybe one thing. Yeah.
Oh, okay.
Okay, sorry. Just one thing I can add is probably the, in terms of talent, right? Because as I think all of you have mentioned, big data machine learning is so much more than just one thing. It's, first of all, market knowledge, experience, but also data, right? Knowledge and experience. Not only that, but technology. And within technology, okay, high performance computing and, storage solutions, right? For example, and all of these things happen at such a fast pace. It's almost impossible for one person to know everything. So in fact, it's very, very difficult to find even a small group of people with a complete knowledge. So I think that's kind of the challenge people face, in particular in finance. And then finance is obviously a very big field, and asset management is a subset within it, and it's even more difficult, right? So because it's a smaller field versus, let's say, another area, let's say technology, for example, where a lot of information is very transparent. Asset management is actually the opposite, where a lot of things are opaque. So that makes it even more difficult. So I think that's one challenge. I think that's quite unique to the asset management industry.
Thank you. Thank you. Indeed. So let's move to the next question. So how do you expect regulation to adapt to artificial intelligence in asset management? Do you guys think it's going to follow a similar pattern as, this regulatory changes that happened on the the sell side? Do you feel like it's going to require more understanding from the part of the regulators, or more involvement on the part of each one of us? What are your thoughts?
I think there's two pieces that are really tightly interrelated there. One is the regulatory side, which I think different regulators are taking very different paces and approaches to how they want to regulate advanced machine learning and AI. And that I think is one piece. And then I think there's the corporate risk governance and risk side as well. I think the regulators overall seem less concerned by how explainable your model is and more concerned with how explainable your decisions are. I think corporate risk and governance people seem to maybe have a little bit more concern with how is the model working, as opposed to just, can you explain the decision? But even there, explainability, we're putting quite a bit of time and effort into that, and our customers are as well. Explain to who? It's very different to explain it to a data scientist versus a lawyer versus a regulator versus a reporter for a large newspaper when you had an algo trading oops, right? So these are all very different audiences, and I think explainability links all of those topics and it flows back to the regulator in a complicated way. It's an interesting time to be in the field.
Yeah, definitely. I mean, there's, we've all heard of biases in the data that translate into biases in the models. But there's also more complications around, I think, around the responsibility in the case of losses, right? So it'll be very interesting to see, especially as we make progress in on the regulatory side, how our responsibility is going to be assigned when there's a big loss, right? In the auto industry, right? Like there's a lot of discussion around these self-driving cars, right? And what happens, and can you really blame the algorithm? And there, obviously, the loss is much more, right? Because it could end in loss of life. But also in finance, right? Like it's not as onerous as in the auto industry, but it would be interesting to see how that gets basically assigned in cases where there's a more tight integration between the human and the machine, right? And ideally, I mean, we'll talk a little later in the panel about where we see things going in like medium term. But I think this is an aspect that needs to be addressed. Any more thoughts on this? Shall we move on to the next question? So how are asset managers using alternative data? And please provide as many examples as you can. So Peter, I'll start with you on this one.
We obviously have a lot of conversations around the use of alternative data. Most of that surrounds our own data, right? But I think what's very interesting, I tend to split it. I mean, you see the use of alternative data across many different sort of investment horizons. You see it intraday in algorithmic trading, in market making. For instance, sentiment data is very heavily used. Concrete example could be, looking at overnight gap returns, for instance. If you see, a price gapping quite a bit, overnight you might expect sort of a reversal pressure in the following trading session. You might start to look at whether there has been any news data or something like that has come out overnight that have sort of supported that price gap, and that tends to sort of result in continuation rather than reversal. So that could be one way that some people are using the data, but you're also looking at, news volume data, sentiment data to gauge and incorporate into multi-factor models, either as on a standalone basis, right? Or as an overlay to an existing factor. That's a quite normal way to apply it as well. Understanding, for instance, when momentum is running out, that might be when there's a lot of press moving against you, right? Or if you look at value signals, when is a company cheap? Well, you might not want to buy it if there's been a lot of bad press recently. So it justifies why it's sort of been trading off. So it prevents you moving into a value trap. So these are sort of more traditional type of applications that we have seen. And we have also been seeing perhaps more recently, more complex applications going deeper into the underlying content, trying to understand various narratives in the market. Are we talking about? Is there a growth theme in the market? Is there inflation, reinflation theme, these sort of things, and trying to look for various alternative data that might help you sort of get a sense for the narratives in the marketplace right now. We're also seeing a lot of use cases around trying to connect various data sets to understand relationships, right, between companies, between countries or other things. So almost thinking about it more like it's not a knowledge graph per se, but sort of linked to it, and seeing how information disseminates across networks and how that can influence our decision making. We have also seen, COVID has sort of also triggered to how the industry looks on alternative data. I think people have really realized that you have to think about your data strategy more in depth and think about the various key risk indicators that could influence your business or your portfolio, and thinking about how you link in all of the various alternative data sets. For instance, something like TomTom data, or something that connects traffic, right? The traffic data, cars going from one city to another has been very useful for understanding whether you were in a lockdown during the COVID situation earlier in 2020. People have started tapping into shipping data and so on to a large extent. So some data sets that might not have added a lot of value to you on a day-to-day basis suddenly kicks in and becomes super valuable in certain environments. So people have definitely started thinking in those type of directions as well.
Yeah. And Peng, I know your team works a lot with alternative data as well.
Yeah, so I think so Peter obviously has
that.
said a lot about NLP data and some related data sets. So I think based on our experience in 2020, I think probably there are a couple of other types of data sets that are popular. One is nowcasting. I think Peter touched on it already as well. But let's say GDP data, right, or non-farm payroll, very low frequency, comes out once every quarter, once every month. We want to know exactly what's happening in the economy right now. So we use shipping data, we use footfall, we use Google mobility, et cetera, open table reservations to give a accurate high frequency picture of where the economy stands. So I think a lot of our clients find it extremely valuable. So that's one set of data, right, that was popular in 2020 and continue to be. Another one is, I would say, in 2020, in the high volatility environment, positioning and flow data has become increasingly important because, generally speaking, we find market liquidity to be very, very poor, and therefore every single trade, the market impact has increased, right, much more than when liquidity was abundant. So to understand where the flow is going, where the positioning is for each type of asset managers and investors become much, much more important. So the most notable example right now are the retail investors. Okay, so we can't detect retail flow from, let's say, market microstructure data, but at the same time, we can also cross-validate it against some of the sentiment data, right? We've seen a lot of data vendors proposing to mine, let's say, Twitter or Reddit, et cetera, et cetera. So I think that's a great use of and great example of alternative data. So and that kind of complements with, let's say, market microstructure or other kind of data to give a very good picture of where do investors stand, where the positioning is. So, that's very useful as well. And those are the two types of data sets I want to highlight.
I think the only thing I'd want to add is that, again, these techniques in the toolbox, right? The various deep learning and advanced ML techniques aren't always going to be better than just a simple linear mixture model. But sometimes they are. And I think they are one of the few things that will let you spend a lot of effort looking at multiple different types of data streams and data feeds together and focus on looking at the data together as opposed to really clever ways to turn them into something that you can feed into a linear model all at once, right? So I think it opens the doors to a set of analysis and cross-analysis that maybe isn't available with normal tools, right? A variational autoencoder with dropout is a great way to build a context picture from various data streams coming in at various times. And so I think there's some techniques there that are really enabling more people to do more of that kind of work.
Yeah, thank you. Definitely lots of interesting stuff there. So, and finally, on to our last question of the panel. Where do you see the future of AI in asset management 5 years from today?
So I'll start.
John, would you like to start?
Go
Okay,
ahead.
maybe John. No, John, go ahead.
Okay. So I've been actually talking about that particular topic a lot recently with customers and in events. I think the role of the human trader is not, and discretionary trading is not going away, right? We can build brilliant AIs that can do point things. They can do one task really well. And some of those tasks are hard, and I can build a system with enough of them to do a lot of things. But ultimately, putting that together and assembling all this knowledge into a context and a thesis and explaining it to people and getting people to say, yep, I trust that with $10 billion. I don't think AI is quite going to be there. And so there's a central role for people. But I think the asset manager without AI augmentation, who isn't supported by a set of AI assistants, if you will, I don't think there's going to be a lot of them left in 5 years. And I don't think there's going to be a lot of new names showing up on the scene in 5 years that don't have that AI backing and assistance. On the algo side, it's going to be just another tool in the toolbox. It will be business as usual. If you don't have that tool in your toolbox, someone else is going to be eating your lunch. That's my prediction.
Yeah, so actually I was going to say almost the exact same thing as John, but in fact, I'll take it one step further, right? Like, I think a lot of people, on the buy side or the sell side, they struggle. Okay, I have analysts who make recommendations or predictions, and then I have a model who makes predictions. Now, how do I incorporate systematically these two predictions? Sometimes they agree, sometimes they disagree. How should I weigh them? How do I, maybe even better, use analyst input as priors for the model so that it produces outputs that optimizes the human element. So I think that is obviously a question we have been struggling for a long time, generally speaking, right, in the machine learning field. But I think we have some tools that are now available which were not, let's say, 10 or 20 years ago, for Bayesian statistics, for example. So GPU is great at, doing MCMC. So, whereas before we had a curse of dimensionality, and now maybe we can avoid that. And we're also seeing development in quantum computing, for example, where, maybe that will help us do away with the curse of dimensionality and move on to kind of a more seamless integration between human and machines, by way of, let's say, Bayesian Bayesian methods. So I think that's one direction which we could see developing in 5 years.
I also think that we will see. I mean, it's very much along the same lines. I mean, I think there will be a lot of increased focus on building out workflows that you've put in front of humans, right? Or where humans play a big part, but where they can utilize the tools. So you have your business analysts, you have your PMs that can use the tools to almost curate insights or curate insights that they need right now, and using one-shot type modeling in some way, or with some sort of feedback loop between so algo and human to build the data sets that you need to address particular problems that you sit with. And I think, again, I mean, to go back to what we have experienced over the last year, that has sort of pushed on the need for these type of things, that we have seen these sort of situations pop up out of the blue. Trump's trade wars, COVID situation. We have seen some big protests this year, last year. And all of these sort of thematic risks, markets have been very thematic. I think that puts pressure on being able to put tools in front of humans to sort of tap into the big data lakes or the data mosaics that firms are producing. And I think that will be a massive trend over the next 5 years.
Yeah, and I concur with you guys. I'm also of the opinion that the human plus machine, as opposed to machine replacing human, especially on the discretionary side, I think we'll see perhaps more seamless integration, more online, versus including like a feedback loop and integrating that directly into the algorithm that would then in turn churn new results, as opposed to this more offline model and using it as almost as an afterthought. But I also think we'll see a little bit more systematization in areas that have traditionally not been very systematic, like more fundamentally driven, like fixed income, for example. So yeah, it looks like none of us are thinking that the machines are going to to replace humans in the next 5 years, at least in asset management. So that was the last of our questions. Thank you guys for a great panel, and we'll hopefully meet again in the next one. Thank you to the organizers of AI4 as well.
Awesome. Thank you so much to all of our panelists, and thank you, Ioana, for moderating so wonderfully. The audience is giving you a big virtual round of applause. We really appreciate you sharing with us today. All right, for the audience, it's time for you to make your way to your next session. And along the way, make sure to connect with your peers by accepting your connection request, as well as checking out our awesome AI exhibits. Thanks so much, and we'll see you around.